Hey, how's it going, everyone? My name is Amos, and welcome to Dividend Compounders with Cheese. In this video, we're going to be going over the companies that I think are going to be very important, and I will personally be watching because this week is crucial. We're going to be finding out who the next president of the United States is going to be. It's either going to be Kamala or it's going to be Donald. To kick things off on Monday morning, November the 4th, the first company is going to be Constellation. I'm pretty bullish on the future of utility companies because most of them are making the transition right now from using fossil fuels to utilizing clean energy. And when they go from using coal and other sources like that to using clean, renewable energy, their profit margins will be a lot better than they are right now. But not only that, in most areas, when you think about it, it doesn't matter if you live in the South, or the North, or in the Midwest, you only really have one or two options for your utilities. What I'm trying to say is that they have a guaranteed customer base, and I really like that. It's going to be consistent, reliable, and that revenue is going to come in on a predictable basis because as Americans, we can't go without our AC in the summer, and in the winters, we can't go without the heater. Utilities are the definition of a toll booth company. You either want your lights on, or you can use candles to find your way around your house when it's super dark at night. One of the best performing utility companies right now in the stock market is Constellation Energy. However, before you get too excited, put your pants back on. I think the ship has sailed with this one. I think it's too late. And to be honest, I was not expecting Constellation to take off like a SpaceX vessel headed towards Jupiter. I didn't see that coming. And I say that because I think the world and political leaders are understanding the power behind nuclear energy. People are understanding that wind power is overhyped, and it's not exactly the best source to get power. And solar power isn't enough. It doesn't generate to meet the demands of certain stuff, such as data centers. And that's where Constellation comes in. They generate most of their utility power from nuclear sources. And I know, when you hear the word nuclear energy, it sounds absolutely sketchy and scary. You start thinking about Chernobyl and then that one nuclear plant that exploded in Japan not too long ago. However, when it's done right, nuclear energy is pound for pound the most efficient way to generate power. It's also what powers the submarines in the United States Navy. But anyways, why is Constellation one of the best performing companies of 2024? Well, Microsoft and Constellation have entered an agreement to become partners, which means Constellation is going to power Microsoft's AI data centers for the next 20 years. And if you know anything about data centers, then you know that the demand is only going to increase, right? So this company is going to have a reliable and predictable income revenue source for Microsoft. And Microsoft is not one of those companies that's going to be here today and gone tomorrow. Microsoft is one of the magnificent 7 technology companies that is stable and growing and is a behemoth in the stock market. So to have that kind of partnership is why Wall Street is very bullish on this company. And then, of course, we have Berkshire Hathaway, which I think is a fantastic alternative to VTI or VU. However, does not pay a dividend. So I'm not particularly interested in investing into this company. Although they are the parent conglomerate that is in charge of Brooks Running Shoes. And in my opinion, I think Brooks Running Shoes are probably the best. Actually, I take that back. I think Saucony and New Balance and Asics are also up there in that conversation. Nike, unfortunately, I think is overhyped. And then we have Marriott International. If you watched my rate cut winners video, then you know that one of the industries and sectors that I am most bullish on right now going into 2025 is the consumer discretionary category, meaning the stuff that we spend money on that we don't necessarily need. Reason being is that I think as inflation comes down and people start to spend more money to enjoy their lives, one category is going to be vacations. And when you go on vacation and travel, you're going to be staying at hotels because most of us are sick and tired of the demands that we need to meet and fulfill when we stay at an Airbnb, such as doing the laundry, cleaning the toilet, doing this and that. We don't want to do that. When we're on vacation and we stay at a place, an accommodation, we want to just leave in the morning, right? And that's what you can do with a hotel. Anyways, that's a rant for another video. Marriott is one of those companies that I am currently researching right now and I will be monitoring because if this company goes on a dip and has like an unexpected unexpected disappointment and Wall Street punishes them like 20% or 30% and they decline by that much on that day, I'm buying in. Even though I haven't finished conducting my research, I'm buying in. It just shows you how bullish I am on the hotel and resorts space. However, I don't want to say too much because I will make a dedicated video as to why I feel this way. I also have Yum China. So Yum Brands, as we know them in the US, they're in charge of what? KFC, Habit Grill Burger, which if you've never had Habit Grill Burger, they're pretty darn good. I would say it's up there with In-N-Out and Five Guys. And they also have Taco Bell and Pizza Hut. However, this stock right here, Yum C, is Yum Brands' portfolio consisting of the China restaurants. Right now, I am on Yum China's website, and as we scroll down, let's take a look at what restaurants they have operating in China. And by the way, if you think the US has a huge demographic and target customer base for restaurants, we're operating with like what? Just shy of 400 million people, right? China has over 1 billion people. To think that there's a potential billion customers existing in China, bro, that's crazy. But anyways, they also have Pizza Hut. Oh, I should say this. I visited Beijing about 10 years ago, and I actually had Pizza Hut over there. It was phenomenal. I liked it. It tasted a little different from the American Pizza Hut, and I think that's because it's tailored towards the local customer base. But they have Pizza Hut. They also have Taco Bell, Little Sheep, which is a hot pot restaurant. Little Sheep Hot Pot, as you see right there. They have, I don't know if I can pronounce this correctly, but it's Huangji Huang, Chinese casual dining. I think of it as probably like what? Texas Roadhouse, what it is to Americans. Lavazza. What is this? An Italian restaurant? Coffee shop? Oh, it's a coffee shop. So that's what they're working with. Me personally, it's not that I'm bearish on Yum Brands. It's that I just don't feel comfortable with investing into any company that operates predominantly in China because of the geopolitical landscape of that country. So for me, it's a pass. But I wanted to throw it out there because it is a pretty interesting company that's trading at a 21 PE ratio. Dividend yield is decent at 1.4%. It's okay. But the thing that holds me back with Chinese companies is how much the CCP has an influence and can sometimes alter and manipulate the companies that exist in China. So as a result, it's just not for me. And before we go any further, I wanted to show you the performance of Constellation as I was talking about it earlier. So, beginning of the year, they were trading at about $115 a share, right? This is a utility company. Remember that. Currently, year to date, they're up by 123%. When we zoom out to 5 years, they were trading roughly at the same price as like Dominion Energy, right? Like about $57, about $49 a share. And that's because this company entered into that agreement with Microsoft. Here's my hot take as to why I said that I'm bullish on Dominion Energy in one of my recent videos. I can't remember if it was the rate cut video. I think it was the rate cut winners video. Reason being is that Amazon is building out their data center warehouses right now in Nova. And Dominion Energy is one of the predominant utility players on the East Coast, which also serves the state of Virginia. So what I am hoping for, it doesn't mean it's going to happen, but what I'm hoping for is that Dominion can enter into an exclusive contract and relationship with Amazon in order to power their data centers. And if that happens, I can absolutely see Dominion Energy popping off like Constellation did. So right now, Dominion Energy is trading for about $58 a share. When we zoom out 5 years ago, my goodness, look at this dip that they went down on. It's because they kept giving declining forecasts and guidance on their financials and profitability. But that's because right now they're going through this period of transitioning from using their old energy sources to now trying to rely on more renewable, clean energy. And as they do that process and make that pivot, I think this company is going to be okay. Whether or not that Amazon theory comes to light. And then as we end the day on Monday, there's two companies that I'm going to be looking at. Number one is going to be Wynn Resorts. This is not your typical hotel company, right? Wynn Resorts operates some of the most bougie and luxurious resorts around the world. In particular, their home base is in Nevada, more specifically Las Vegas. So if you're bullish on Las Vegas, I guess this is an alternative to the REIT, Vici. And then, of course, there's Palantir, one of those original meme stocks that ended up becoming a very high quality company. I think back in like 2021, 2022, people weren't really sure because the company was really speculative and their CEO is a pretty interesting guy. And based on all of that, yeah, I bought into it. I bought into their investing thesis a while ago. And when I was up in the green, I think this past year or maybe like a year and a half ago, I sold out of it. Basically, Palantir is in the business of data analytics and data monitoring for our intelligence agencies and the military for the most part. I think they also have some commercial clients, but they cater towards the DoD and to the Pentagon and military groups. This is a company that will continue to succeed as long as cybersecurity threats are still a thing. Do I regret selling on a Palantir? No, I do not. Do I think the ship has sailed? No, I think this company is still in its infancy stage, and we're just now starting to learn how important they are when it comes to like monitoring attacks and data analytics when it comes to military operations. In my opinion, I think this company has a bright future. As I just alluded to, as long as cybersecurity threats are still something that we need to be worried about. So other companies that you can contemplate include Cloudflare, ticker symbol NET, I love that, Cisco, Palo Alto Networks, which Nancy Pelosi bought a crap ton of shares into, and Okta. Those are some other companies that you can research and contemplate if you are bullish on the cybersecurity industry. And as we go into the next day, Tuesday is a huge day for us Americans, and I guess everyone else that buys into stocks that are based in the US. It's election day, and I'm sure the entire stock market, whether you are an investor in New York City or living in a rural ranch in Wyoming, we're going to be nervous or excited at the idea of our next president and commander-in-chief being voted on and elected, and they're going to take office in January. But depending on which candidate wins, I'm bullish on different stocks. I don't think the stock market is going to be the same under the opposite one. And I made a video on each candidate with details on which sectors and stocks should succeed. So if you're curious about that, go ahead and watch. But anyways, the first company that I'm going to be looking at on Tuesday is ADM, also known as Archer Daniels Midland. I've been eyeballing this company for almost a year now, but I have not bought into it because my price target is around $50 a share. So they first went on my radar when they dropped back in January of 2024 from $69 a share to, to $51 almost overnight. After I saw that happen, I was like, okay, is this sell-off warranted? And I started to do my research and look into this company, and then I realized, okay, so they're going through some headwinds, and I decided to leave it at that. However, I've been monitoring this company for almost, 11 months now? I still have not bought into it, and I've been trying to buy into it, but it has not reached my price target. If they hit $50 a share, which, between you and me, depending on their earnings report, they might hit that price. I finally might get the opportunity to pull the trigger. Reason being is that when I see a company go from like here to here overnight, dropping 25%, I try not to buy into it because you don't know if that's the bottom. It could also go down even more, free falling. But in this case, it did bounce back up and recover, and they, at their peak of the summer, they started trading for about $65 a share. So had I have bought into it as they were going through that massive sell-off at about right there and held on to January, I would have been up by 25%. However, since January, they have been on this slow and steady decline, and more likely than not, I'll probably get the chance to buy into them. By the way, their trading multiple is a 10. Their dividend yield is 3.6%. I like what I see on surface value, and I gotta circle back and reference my papers that I did on this company to see my thought process on why $50 a share. But anyways, if you don't know what ADM is, let me give you a quick high-level overview. This is a company that is in the business of turning soybean into soybean oil and corn into high fructose corn syrup. And they also deal with other farming ingredients and crops. So think of them as the folks that allow General Mills and Kellogg's to make their products the way they do. They turn raw farm products into highly processed ingredients that make the food taste sweet and delicious and, to a certain degree, addictive. Right now, This company is going through, I should explain why they're going through the sell off, right? This company is going through major headwinds. Okay, number one, the SEC is investigating their accounting practices because their numbers are not making sense to them. So, anytime the SEC probes a company, Wall Street starts selling off immediately because more often than not, good things are not going to happen and they're going to have to end up paying a fee. Best case scenario, they're going to walk away saying, okay, it was a misunderstanding. Worst case scenario, they're going to end up paying money. Number two, they're in the commodities business. And right now, things are not looking too hot for them. Inflation across the board is ridiculous, right? It's increasing the prices of all the commodities and our ingredients and supply chain. So their forecast and guidance towards Wall Street, for the most part, has been bearish. The leadership team claims that it's only going to be temporary, but Wall Street hates to hear those words. The moment you give a lower guidance and forecast, Wall Street just says, all right, we're out of here. Peace. Because Wall Street is in the business of making money. And if you're not going to be making money for Wall Street, they're going to take their money and put it somewhere else. And lastly, I think the market right now, this is just me, okay, this is my hot take. I think the market is pricing in the victory of Trump and RFK Jr. If you know anything about RFK Jr., he hates the corporate food industry because of all the artificial ingredients and sweeteners that are added into our food. And he thinks that's one of the reasons why we have a health crisis going on right now with obesity. So I imagine if Trump wins, RFK Jr. is going to go hard after this company, General Mills, Kellogg's, Hormel. But realistically, they're going to have to meet somewhere in the middle, as ADM's lobbyists will probably protect their interests by, claiming and saying that it's going to affect the bottom line of the farmers. Think about the farmers. We're buying their crops and helping them out. If you make us change our business model, it's going to hurt the farmers. We're not going to be able to purchase the same amount of soybean and corn. So I think RFK Jr. and ADM and the farmers, they're probably going to meet somewhere in the middle, and this company is still going to be okay. Other than ADM, I'm not really interested in any of these other companies that are reporting their earnings before the market opens on Tuesday. And as the market closes on Tuesday, there's one company that I am laser focused on and paying attention to, and it's going to be Devon Energy. This is a company that is a part of the oil and gas industry, and out of all of the companies that I have done an investigation, research, and analysis on, I'm most bullish on this company. Not in the sense that it's going to grow, but in the sense that it seems stable for the most part, and they stay relevant by making inorganic growth through acquiring the smaller players that are in their field. Their dividend yield is somewhere around 5%. Here, let me just pull it up. So let's see. Devon Energy. Okay, so their dividend yield is 5.2%. The PE ratio is 6.9%. Depending on how their earnings report sounds, this company might fall down further to around 37. I think it was around $37 was their line of support when I looked at their chart. So if I am able to buy into this company at $37, I might pull the trigger. Because when you zoom out and I take a look at their price, this company is at a historically high valuation right now. It's not unusual for this company to be trading at a PE ratio of like a 4 or a 5. So even right now, I know it sounds crazy, this is kinda a premium valuation for Devon. I think for the most part, this could be like an alternative for me. Instead of investing into bonds or a treasury note, this is something that I would buy into for like that stable dividend. And speaking of dividend, Devon Energy is one of the few companies on the stock market that gives a special dividend every so often. So right now you'll get like a 5.2% dividend yield. You could expect a dividend payment every 3 months. But on top of that, you'll get like an additional 99-cent dividend for each share that you own. Something like that. And I'm a fan of that. So my biggest fear with Devon is, what if I buy into it at $37 a share because they have a lukewarm earnings report, and then it drops further down to like $22, $23 a share? At which case, their PE ratio is going to be like a 1, right? So I don't know. Is that realistic? Probably not. But this company, I don't know. Their main focus right now is developing and fostering a fortress balance sheet because they realize their capacity and ability to grow is long gone. This is not a company that has a bright future. Rather, it's a company that's going to be stable and is very mature. Anyways, moving right along, another company that I'm going to be eyeballing is Coupang. Reason being is that I am actually invested into Coupang in my Roth IRA because my Roth IRA, the investing thesis and horizon for the companies that are in that portfolio are for the long run, like 20, 30 years, right? If you don't know what Coupang is, essentially it's the Amazon of South Korea. And right now they're branching off into other territories of Asia. They not only do e-commerce, but they also do like DoorDash and Uber Eats deliveries. And they also operate a streaming website that plays movies and TV shows. Basically, they're doing exactly the same gameplay as Amazon. So this is a company that I'm very bullish on and invested into. Not going to be selling out of it anytime soon. This is just one of those like buy and hold long-term companies for me. Moving on to the next day, we have Wednesday. Before the bell, we have CVS. This is a company that I invested into. I do not recommend copying me because it's a high risk, high reward type of investment. CVS is going through a period of transformation right now. They're trying to pivot away from relying strictly on the retail arm and more towards the health insurance arm of the business. Aetna. CVS is 1,000 times better than Walgreens. However, I think it's slightly below the high quality nature of United Health. So on the spectrum of like health insurance companies fighting in the Medicare space, I would have to give United Health the props where it's due. I think United Health is the best standard of health insurance companies. Right below them, I would say Humana. And then below that, I would say CVS. However, with that said, I am bullish and optimistic about their turnaround and their future. I think for the most part, if things don't go too well, this company will probably trade flat for a year or so until they can pick it back up. And when they do, I think this company is going to be trading at a fair valuation, and I should be up huge in the green from my investment. Anyways, what else is happening on Wednesday? We also have Toyota. Although they make fantastic cars alongside with Honda and Hyundai and Kia, I would not invest into any car manufacturers because I just don't see a growth investing thesis that is exciting and sexy. I think the only car company I would entertain is, well, actually maybe two. Number one would be Tesla, because obviously they have a crazy eccentric CEO that is actually changing the automotive industry. I think a report just came out not too long ago where they're giving Uber drivers $2,000 if they decide to buy a Tesla in order to drive for Uber. But anyways, I think Tesla is one of those car companies that have a good future. And then number two, this is a hit or miss. I'm not bullish on them, but I'm just saying they have the ability to flip the industry upside down, would be Rivian. If someone were to hold a hammer up to my nuts and I had to pick a car company to invest in, it would be Tesla, and I wouldn't touch any other car company. As the market closes on Wednesday, we have AMC, the movie theater company, reporting their earnings. And then we have ARM. This company is interesting because NVIDIA tried to buy them out and acquire them. Alina Khan of the FTC blocked it and did not allow that to happen. So this is an interesting company that is a part of the semiconductor space that even NVIDIA wanted to acquire because they see something juicy within them. I have not done my due diligence and homework, but I just know that this is a company that complements what NVIDIA is doing in the AI space. And then we have Qualcomm, the ones that make chips for our cell phones. We have e.l.f., the ones that make affordable makeup cosmetic products at Dollar Tree, at pharmacy stores like CVS, and is a fan favorite among those that are more cognizant of their spending habits. And then there's Clover. I believe it's a health insurance company it's new, it's a startup, and they're trying to make a splash in the Medicare space, which, as you know, the big players are probably not going to allow this company to succeed. And then, yeah, I'm not too interested in anything else. And then as we move into Thursday before the market opens, we have Vistra Energy. Let me just say this right now. This is also another utility company that is operating with nuclear energy. And believe it or not, this is a fun fact. They are pound for pound the best performer in the S&P 500 for 2024. Let's just pull them up really quick. So VST, if we take a look at this, year to date, they are up by 214%. Yes, a utility company. And they're one of the largest power producers of retail energy. And people in Wall Street are bullish on Vistra because they had the vision to pivot into nuclear energy before the other utility companies had a chance too. So sometimes it pays to be the first and forerunners of an industry or a transition, because when we zoom out and we look at their price chart, up until very recently, they were always trading for like $20, not too high, right? And then once people realize, like, dude, nuclear energy might be the future of powering the grid and electricity, look what happened. Beautiful, phenomenal. And that's why I'm saying there's winners in every single industry, category, and sector. Yes, even in oil and gas. Yes, even in pharmaceuticals. And as you can see right here, even in the utility space. And I'm not trying to be negative, but I do think the ship has sailed with this one, and it is too late. This is long gone. So right now, I am riding high on that Dominion Energy thesis, partnering up with Amazon. And as we move down here, we have MPW, which some people really like because it's a REIT that pays a decent dividend, and I think their property is in the medical space, like clinics and hospitals. Me personally, I'm not really interested in MPW. And then there's also Hershey. Now, hear me out. This is a company I am heavily invested into. I believe in the products and its future. Do I consume anything that Hershey makes? No, I do not. I also invest into Starbucks, but I don't drink coffee. However, right now, Hershey is going through some headwinds, right? Such as the price of cocoa and sugar being more than usual thanks to inflation, which means their profit margins are not as good as they used to be. So Wall Street and investors are pretty bearish around this company because their margins are not looking cute. However, my opinion is this is an opportunity to buy into a high quality dividend compounder with cheese while it's going through a dip. I think of it as a temporary setback. On the other hand, I could be wrong and folks will never eat chocolate again thanks to Ozempic and their products are trash, and the next generation is going to be eating kale and spinach instead of candy and sweets. I could be wrong. However, as for me, if it goes on a further dip on a Thursday morning, I might pick some more shares up, depending on the news and what they say on the earnings report. If their future is actually pretty terrible and trash and smells like farts, and they decide to cut the dividend, then I might jump ship. That might be an opportunity for me to leave. Because once a company cuts the dividend, then I know their future, at least for the next 5 years, is going to be in for a wild ride. And I don't want to be a part of that wild ride. And as the market closes on Thursday, we do also have some other cybersecurity companies such as Arista Networks and Fortinet. And then we also have Block, the payment processing company. Oh my gosh, there's Rivian. What the heck? Didn't we just talk about them? And then we have DraftKings, the sports gambling and betting company. And then there's Pinterest, which, by the way, I just don't see the investing thesis behind Pinterest. It reminds me of Snapchat. If you invest into Pinterest and Snapchat, I just don't see eye to eye with you. And then there's Airbnb, which I am so glad the majority and the common opinion is the same as mine, which is we don't like Airbnb anymore thanks to all of the ridiculous demands that the Airbnb owners want from us just staying one night. Not only do you have to pay for the night, you also have to pay for a cleaning fee, an inconvenience fee. You also have to do the dishes, clean their rug, scrub their toilet. Just not for me. I refuse to stay at Airbnb. I would rather stay at a Marriott hotel than go to an Airbnb. But that's my personal opinion. And then on Friday, there's only really two companies I'll be watching. The first is going to be Fluor, which is in the construction and engineering business, which they are mentioned in the Trump winning stocks video. And then there's Bloomin' Brands. Okay, so hear me out. As I went on a deep dive of Yum China earlier as well, I love investing into restaurants because their business model is super easy and simple to understand for someone stupid as me. When a business model is not complicated and even your stupid neighbor or cousin can understand it, then I like it. And despite technological advances and AI, we're not going to say no to burritos, to burgers, to ice cream. It's always going to be around. Eating out is always going to be a thing. So that investing thesis just writes itself. However, when it comes to Bloomin' Brands, they have such an unfortunate portfolio of restaurants. And what I mean by that is, right now, the customer, what they want is good value for their money. And each of their restaurants and Bloomin' Brands, I think they have like Carrabba's, Outback Steakhouse, and Bonefish Grill, and one more restaurant. I think it's like a steakhouse. They're not exactly known for their food portions. They're not Chili's or Texas Roadhouse or Cracker Barrel. Bloomin' Brands is not known for that. So my unpopular opinion is that you're better off investing into Brinker International, which is the parent company to Chili's and Maggiano's. Both of those restaurants are known for their generous food portions at a pretty decent price. If you're eyeballing Bloomin' Brands, let me redirect you to Brinker International. And no, I'm not invested into Brinker. I just think Chili's and Maggiano's is a lot better than Carrabba's. Okay? Or my personal favorite restaurant right now is Texas Roadhouse. About 5 or 6 years ago, before the pandemic, my favorite restaurant company was Cracker Barrel. However, Cracker Barrel has not been keeping up with the times and they lost their target demographic, and Gen Z is not resonating with their menu, their image, their brand, and marketing. So I sold out of Cracker Barrel a while ago. And that's what I'm saying. Sometimes, from time to time, you need to look at your investments and see if the investing thesis is still the same or if it has changed. And in the case of Cracker Barrel, it changed, and so I'm no longer invested. It's not always good to just buy and hold through the ups and downs if a company is going through a wild pivot and transition. Case in point, Intel. Like if you had bought into Intel like in, I don't know, 2015, let's just go ahead and say 2015 because that's like 10 years ago. If you bought into Intel 10 years ago, where is this? 2015 at about $36 a share, and you just held on for the ride despite all of the difficulties and transition that they're going through from being a computer chips company to now being a manufacturer of chips. They also still do the computer chips, but they're trying to make that pivot to being a foundry. You would be down by 36%. However, once you heard the news that they're making the pivot because they're struggling and you jumped ship, you probably could have left with a decent profit at about $54 a share after buying in at 35. So I would say a healthy way to evaluate your investments is probably every quarter, and at a minimum, at least every 6 months. I'm not saying that you need to watch your investments every single day, but it is healthy and important to look at the companies that you're invested into to see if their investing thesis is still the same. All that to say, my personal favorite restaurant stock is Texas Roadhouse. Not only do they give generous portions, but the bread rolls that they get for free in the beginning, phenomenal, and it's not too expensive. And as we look at this company. Year to date up by 57%. Yes, a restaurant company. Very bullish on them. Love them. Anyways, what do you guys think? I haven't done one of these stocks that are on my radar for this upcoming week type of video in a long time. Let me know what you think. Did you like it? Did you hate it? If you hate it, please let me know because I don't want to waste my time and make another one because this is something that I do every Sunday by myself. So I decided why not just record my thoughts and opinions as we move into this next week. But if you're not a fan of it, let me know so I can invest my energy into other videos that you would like instead. With that said, shower naked today. Touch your right nipple. I love you. Talk to you next time. Stay safe.